let's flesh out the discussion a bit more with Christopher Peel, the CIO of Tavistock Investments. Christopher, it's great to have you with us. Willem and I were just discussing one remarkable characteristics out of the earnings that we've just been talking about in the food and beverage space is the remarkable resilience coming from China. There's good demand there. There appears to be good demand, and it's still showing up in these numbers, even with everything that's going on, domestic slowdown, trade war, etc. What do you point that down to?
It's how one defines a slowdown. The reality of it is the Chinese economy is bigger today than it was 3 years ago, 5 years ago, and 10 years ago. The rate of growth may be slowing, but the actual size of that economy and the demand for goods, consumer goods, manufacturing goods, is actually increasing. So I think it doesn't surprise me that companies are continuing to sell well into China because there's more wealth stockpiled there to consume Western goods and domestic goods.
It's still growing at 6%, yeah.
Can I just posit a theory? These are all European firms selling goods into China. Do you think that matters? We've seen this huge amount of tension between the US and China. Do you think it's easier right now for European companies doing business in China than perhaps it might be for American firms?
Well, certainly supply chains move very quickly, and we've seen that over the last 6 months with the trade war between the U.S. and China. You know, other Asian countries have taken up some of what was coming out of China. I'm almost thinking more about
consumer behavior there, though. Do you think that, you know, because we've heard these reports that there are Chinese consumers boycotting U.S. brands. I wonder whether in the long term, if the tension persists, and it may not, whether that's something that will begin to actually reflect itself in earnings.
I think potentially down the road, but I think it's very short term. I think what we're seeing in the food and beverage space, or the LVMH numbers, you know, China is a huge market, and it's evolving as wealth creation in the development of the middle class is growing. It has a long way to go. So if you're a manufacturing company, especially in Europe, which does a lot of trade with China, I think it's still a fertile environment to pursue an export market.
I want to take it back to individual sector performance year to date. And again, I had a look at this morning. Tech is up 28%, food and beverage is up 27%, construction materials up 25% year to date. There seems to be a bit of a disparity between how these stock market sectors are performing versus the macro narrative. We spent 6 months talking about how weak Europe is, the slowdown in the manufacturing sector, the pressure on the ECB to do more to ease, and yet these cyclical sectors seem to be performing quite well in Europe.
Well, I think that's right. I mean, the fact is we're a long way from 2008. We've had low interest rates for a prolonged period of time, and even though the banking system is still not fully recovered, you know, there is spending power, and you can certainly see it in Southern Europe in particular, with Italy, Spain, Portugal. You know, the economies at a localized level are much stronger. Partly because there's in the case of Portugal, there's a lot of tax incentives for foreigners to go and base themselves there on a longer term basis, and you're seeing that trickle down into the economy.
So whether you're talking about Europe or the US, and obviously we had record highs on 2 of the major indices in the US yesterday, do you think the valuations you're seeing, looking at the earnings season that we're going through at the moment, are reasonable?
I think they're reasonable. In actual fact, you know, I could argue that U.S. equities still are on the cheap side if one believes the Fed is going to continue to, well, it's going to cut rates next week, and then another time by the end of the year, and then potentially next year in the run up to the election.
On a discounting basis.
On a discounting basis. The global growth at 3.5%, and U.S. growth, if one says it's at 2.25%. That's the long-term average over the last 15 years in the U.S. So I don't believe that the talk of a recession is valid. It's a long way off still.
Let's continue the conversation with Christopher Peel, the CIO of Tavistock Investments. To pick up on what you were saying before we ended the previous segment, you said no recession in sight for the US. And indeed, a lot of the headwinds seem to be subsiding. You've got a potential deal, maybe, or at least a softening of the rhetoric between China and US. You've got a Fed who are clearly about to embark on a rate cut. So where do you see the speed bumps coming from in the second half of the year?
Well, I'm optimistic for the second half of the year in that I think the Fed pivoting to an easy mode. ECB, I would expect them to do something today. The PBOC, again, has accommodating policy. So I think that's all very positive to try and uplift the global slowdown that certainly started 18 months ago. In terms of recession, global growth at 3.5%, growth in the U.S. around 2%. Given that China and the U.S., the two biggest economies, as long as those two are growing and trading with each other or elsewhere, I think that's positive for global trade. And I think the trade agreements that are being refreshed or renegotiated are positive in the long term for the global economy. We've had TPPG, we've had revised NAFTA, which is still going through the lower house. But if I'm of the view that U.S. and China both need a trade deal, and that will happen sometime over the next 6 to 9 months, which is positive for the global economy.
So U.S. equities don't necessarily need a trade deal if you look at the record highs that we saw yesterday, but some of the Chinese indices the last 3 months, they've not performed that well. Do you think they stand to benefit in the second half of the year a lot more, therefore?
Well, Chinese equities year to date are up significantly, but over a 12-month basis, yes, they trail the U.S. But I think Chinese equities.
But they've fallen back the last 2 or 3 months, right? So is there a chance you think the next 6 months that trend we saw the first quarter continues again?
I think longer term Chinese equities will outperform the U.S. stock market. If you from a standing start now, looking 12 to 24 months out, I think that there will be a rotation away from the U.S. as you get into the election year. There'll be a lot more volatility in the U.S. exchanges. So I think you will get global allocators or investors looking to pare down that U.S. exposure because these companies are at virtually all-time highs.
It's interesting that you say that in the context of China being an emerging market, so almost emerging markets, because this year we've actually seen emerging market economies benefit from the fact that financial conditions are about to loosen. The Fed is about to start easing, and obviously that's taken some of the pressure off the currency as well. So how do you see that panning out in the second half of the year?
Well, I'm of the view that the main driver for currency movement is interest rate differentials. The fact that the U.S. or the Fed has been largely, I think, pressured by the White House to change their tone or their policy. I think that's negative for the U.S. dollar. So which I think longer term is positive for commodities. It's positive for emerging markets. And I think that will fall through into investor portfolios in the second half of the year. So you asked me about the bump. The bump could be that the Fed doesn't cut rates or isn't as dovish as the market expects over the next 6 months, because that'll put pressure. Well, that'll detract from the being negative on the dollar.
Okay, so your big call then is short dollar for the second half of the year. All right, Christopher Peel, thank you very much for taking the time to speak to us.